what's up everybody? Tuesday, June 22nd. I sent out the new edition of MMT Trader. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. Alright, yesterday I said not looking too good. Now I've been hoping that these numbers, first of all, let me just say, I've been anticipating and I've been telling you guys that, I was expecting to see a deceleration, a slowdown in the fiscal flows because, you got half the states now that are cutting these unemployment benefits. I've been warning about this for weeks and I've been saying, look, now's not the time to be cutting these benefits. I mean, net transfers, right? I mean, that's income to households, that's corporate profits, the stock market, the economy rests on that, all right? And I have to tell you, I've been seeing the numbers now, and so far, it looks pretty obvious that the flows are slowing down. I mean, the last 2 days, and really the last 3 days, I have seen a precipitous fall in those daily flows. I mean, it's significant. And I mentioned in the last 2 videos that the deficit is now down 88 billion versus the same time last year. And remember what I told you yesterday. Whenever you hear me say the deficit, or whenever you hear anyone say the deficit, just reframe that in your mind as net transfers to the non-government, net transfers to, the people, the economy. That's really the way to think about it. So like when I say the deficit is down 88 billion compared to where it was at this time last year, it's the same thing as if I said net transfers are down 88 billion from where it was at this time last year. So it's actually like, think of it as sucking out 88 billion. That's not a little bit of money. I mean, and that happened basically in, 2 days, 3 days. We went from a deficit. Let me go back. I mean, the deficit, back in April was $1 trillion over where it was last year. So net transfers $1 trillion more than where we were last year. When you think about that, it's pretty easy to understand why the stock market and everything else went up, the reflation, the whole reflation trade that, we've been hearing about. That has gone away. We're now negative year over year, 88 billion. So on Friday it was, or on Thursday I should say, it was negative 22 billion. On Friday it was negative 46 billion. Yesterday is negative 88 billion. It's getting worse. It's getting worse. So net transfers are slowing down, and they are down compared to where we were last year. And yesterday I gave a little kind of a thought experiment. I said, look, last year at this time, when net transfers were higher than where they are right now, the S&P 500 index was at 3,200. Today, when net transfers are lower than where they were last year at this time, the S&P 500 is at 4,200. So something's out of whack, or, I guess I should say, it looks like there's a pretty good possibility that the stock market can have a pretty decent correction here. Now, I could be wrong. We may get a new credit cycle. Remember, there's 2 kinds of money. There's the government's money, right? That's called vertical money. And there's horizontal money. That is credit. Credit is bank money. All right, and we can get a new credit cycle where bank loans, could support people or keep the economy going for a while. There's only two problems with that I see. Number one, the banks right now are struggling with this reserve situation, all right? I've been talking about that. You probably have heard about that from other, whatever, that all this massive reserve addition to bank balance sheets, it's been constraining their ability to make loans. Now, I noticed some pickup in loan growth, like in consumer loans, and that's interesting when you think about it, because maybe people are like, I see it in credit card and revolving credit. That's starting to pick up. And so maybe people are tapping into credit now as those unemployment benefits are going away. I mean, that's one possible explanation. The other thing is that I think that would mitigate against a new credit cycle is that as incomes start to go down, right? You're not getting those monthly payments, those weekly payments anymore. Credit worthiness, borrower credit worthiness, the ability of a borrower to go to a bank or a credit card company and get credit, that goes down, right? I mean, credit worthiness is a function of your income and your debt, but also your income. So I don't see really the potential for a big new credit cycle, but we'll see. But right now, the numbers are not looking good at all. Again, everybody's looking at the Fed. I mean, we had Powell talking today. I don't pay attention to that stuff because I understand what the Fed is. I understand that the Fed is a bank. It lends against collateral, and it has the special role of setting interest rates. And I understand that interest rates are price adjustments. And, one sector of the economy can benefit and one sector can lose, all right? Inflation is not universally negative. Someone benefits and someone loses. Producers benefit, consumers lose out. Deflation is not 100% negative either. I mean, some cohort benefits, savers benefit, debtors lose out. All right? So, I mean, you can't just, and you hear it all the time. I mean, Yellen even said, higher interest rates would be great for the economy. No, it's, one cohort wins, one cohort loses. So when the Fed does something, I never freak out. I don't even pay attention to that. I only understand that there's going to be a zombie reaction from that, and I know how to take advantage of it. I understand what the central bank is. I mean, it's a bank, and it sets rates on behalf of the government, and that rate setting is a price adjustment, and it's also a fiscal adjustment as well. So I don't get crazy over it. I see what it is, and then if I have to strategize off of that, most of the time all that entails is really just going against the zombie reaction. That's about it. All right? It's fun. Because you know how people are going to behave. And again, I said this yesterday, they're all looking at the Fed and Powell and this 5 basis points increase in interest on excess reserves, and there's going to be maybe 2 rate hikes, 2 years from now. I mean, if you think about it, it's ridiculous. It's ludicrous that people are so freaking fixated on this. Oh my God, 2 years from now, they made a little dot plot. And they're saying, I think in 2 years from now, we're going to have a rate increase. Oh my God. And everything went crazy. And so, yeah, it was right that it snapped back. But like I said yesterday, I'm over here looking at the fiscal. Those flows drive everything. I mean, let all those people focus on Powell, and let them focus on 5 basis points, and let them focus on, 2 years from now, they might do something. I mean, think about that. People freaking out. 2 years from now, they might do something. Oh my God. That is, an absolutely apt description of what happened last week and the reaction to it. That people literally went berserk because on a little chart, they asked the members, well, where do you think? And 2 years from now, maybe we're going to raise interest rates 2 times. I mean, it's silly, folks. Come on. Come on. Really. Wake up. I mean, come on. This stuff, I mean, it's almost hard to believe. Like, you got all these serious people talking about this stuff and markets whipping around like crazy. And the real thing that they should be focused on, nobody's focused on. Anyway, I have all this stuff in the report today. I got all the numbers as usual. Go to the website, sign up for a 30-day free trial. See you tomorrow. Bye.